Hello, everybody, once again, and a very good evening to all of you. Thank you very much for taking your evening out and joining us in today's webinar. So, without further ado, let us kickstart and let me do a very quick introduction about Bond Supermart before we begin our session proper. All right, I hope that our attendees today have heard of Bond Supermart. So basically, we are a subsidiary of iFast, and we are basically set up in 2015, and we are a bond information portal. So we find that finding bond-related information is often very difficult given the level of inefficiencies in the fixed income market. So with Bond Supermart, we hope to change the way investors invest in bonds and make bonds more accessible so that investors can make an informed decision before they invest. So like today, we are also doing this webinar to educate and share insights about the bond outlook for 2024. Yeah. So on our website, you will be able to find lots of bond information such as the bond fact sheet that is shown. So the screenshot is a little bit small, but we have extracted to showcase and highlight to you the key information that we have on our bond information fact sheet. So it includes like bond prices, important bond features, so on and so forth. And all this useful information can actually be found without the use of any paywall, so they can all be accessed by everyone for free. So it's something that we do to improve the accessibility of information to our end users. Now, aside from bond information, we also have tools such as portfolio builders, bond calculators, and bond chart center. So this is something that you can actually go and explore on our website, bondsupermart.com, when you're free. So you can actually use this, for example, the bond portfolio builder to create your desired portfolio. Now we are actually like a one-stop shop. Okay, so basically, apart from the what has been mentioned, we also have education materials like research articles, and we also host our podcast series. It's called You Hunters, and it's actually available on Apple Podcasts, Google Podcasts, as well as Spotify. So something that you guys can check out when you're free. Okay, so if you're keen on all of that, but perhaps you're busy, you can actually join our Telegram group chat, all right, where we actually share updates about newborn issues. We also share updates whenever we have a new podcast episode, for example, as well as articles. Sometimes we also do polls to engage our audience, so do join our Telegram community so you can get updates on the go whenever we have new notifications. You can receive them firsthand. Okay, so you may wish to scan the QR code to join our Telegram group chat. And as you can see on the left, we also post infographics. So we hope to break down information into more digestible manner so that it's easy for our readers and audience to understand what is going on. And at a glance, they get a view of the key information to take away. And then you can go on to read our research article for more in-depth information. Yeah, so I'll just stay here for a couple more seconds for you guys to scan the QR code and join our Telegram community. Okay, so without further ado, I think this is what everybody has been waiting for. So here are our speakers lineup for today. All right, so we have Senior Research Analyst Jason, who will be covering the USD bond outlook, followed by Research Analyst Ding Fong. He will be covering and taking you through the MYR bond outlook. And we also have Ming, who will be sharing more on the SGD bond outlook. Now, before we start all of that, I'll now hand the time over to Ming, who will be taking over, and he will be sharing more and kicking start the section with the entire macroeconomic environment. So over to you, Ming.
So hello, once again, I'm Timing. I'm research analyst over at the Global Fixed Income team in Singapore. I'm presenting on behalf of our portfolio manager on this part of the Global Fixed Income outlook for 2024. So while today's main focus is on the various currencies, we have USD, SGD, MYR, we wanted to bring in our global outlook to provide a better overview of how our individual regional views interconnects with our overall bond views. So with that said, let's get started. Let's start off with a recap on the performances of the major bond markets last year. In short, 2023 was a year filled with hurdles for the bond markets, where inflation surprises and policy rate hikes acted as key headwinds for bond markets. As you can see, major bond markets rose in January, starting the year on a positive note. However, US Treasury yields were very volatile in the first half of last year due to US inflation data as well as the Fed's comments and actions. This caused yields to rise and fall wildly, which has kept the bond market performance muted from February to July. In the second half of last year, so the treasury yields began climbing ferociously, especially from late July to November. As a result, for performance of the most bond markets, they had actually weakened much further. Fortunately for investors, this was short-lived as ultimately yields began to fall in November, if you do recall, after the Fed's dovish comments, while at the same time, the credit spreads compressed very significantly, this driving a very strong year-end rally across all bond markets. So overall, despite a very tumultuous year for bond markets managed to generate positive returns. Global high yield bonds were the top performer, returning around 14% for 2023, which even managed to outperform several equity markets. So to this, we have actually derived 6 key themes with regards to our view for 2024. Firstly, we prefer short over longer duration bonds on the backdrop of a higher for even longer interest rates environment. Secondly, we advise investors to stick with higher quality investment grade bonds. 3, we remain optimistic on Asian investment grade bonds, while at the same time, 4, we advise investors to stay cautious on the Asian high yield bond space given the ongoing developments that we see now. 5, onto emerging markets, we hold a neutral position over EM bonds, but at the same time, if we have to choose between the hard currency and the local currency EM bonds, we do prefer the hard currency given the more attractive yields. And lastly, 6, we are positive on the shorter tenor US Treasuries and also the Singapore government bonds, and also the medium-term Malaysian government bonds. Jumping straight into the first key theme, our preference for short over long duration bonds. 2 big reasons as to why we still like the short duration bonds over the longer duration bonds. Firstly, yield curves still remain inverted across major markets, US Treasury and the Singapore sovereigns included. So chart on the left indicates how the yield curve has changed since the start of 2022, from the normal sloping orange curve to the current inverted dark blue line. This simply means that the shorter tenor sovereign bonds are offering higher yields than the longer tenor counterparts, making them more appealing. Secondly, yields of the short duration bonds are also at the highest seen since global financial crisis in 2008. So previously, right, investing into global short duration corporate bonds might only yield you about 1 to 2%, but now we are looking at yields of between 4 to 6%. To top this off, with interest rates likely to stay higher for longer, we continue to expect yields on the short duration to be supported by extended rate pause, therefore staying attractive for investors' consideration. Next, the focus on investment grade bonds is straightforward given the continued expectations of deterioration in credit profile. So the cost of capital as of the current moment have increased significantly, and this is exerting stress on both IG and high yield issuers alike. So with rates expected to stay higher for longer, we believe IG issuers can remain resilient while high yield issuers will be at the risk of greater financial pressure coming in from this higher cost of capital. In addition to the potential deterioration in credit profile, so the current valuations suggest minimal reasons for us to select high yield over the IG bonds. So credit spreads for high yield bonds, they have actually contracted considerably as compared to IG bonds, which high yield bonds are now relatively overvalued. Investors might not be able to be sufficiently compensated for the risk that they have to undertake by going into this high yield space. So a segment that we currently are positive on is the Asia IG bond space, which we are seeing very strong fundamentals in these issuers. Based on our observation, most issuers have remained profitable with positive earnings growth, while credit ratios have held steady over 2023. This tells us that many of these Asian IG issuers are still able to healthily meet their debt obligations. So looking at the credit ratings for these Asian IG issuers, so last year we saw a major improvement in the upgrade to downgrade ratios, pointing to the overall healthy credit profiles. So comparing between 2022 and also 2023, 2022 saw less than 1 upgrade per downgrade in ratings, while in 2023, the segment saw 3 upgrades per downgrade in credit ratings. So overall, given the largely stable credit profiles and economic growth in the region, to remain resilient, we remain positive on Asia IG bonds. They are still carrying attractive yields currently. Next, coming to the Asian high yield space, I think that the conclusion remains quite clear for now. So the negative sentiments within the Asian high yield space, it still remains, especially with the current conditions, whereby even though we do see stimulus being injected by the Chinese government, it is still insufficient to bring about a recovery in the Chinese property sector. So with the Chinese property sector still a large exposure within the Asian high yield space, we still hold the negative opinion on this segment. Additionally, while yields might seem alluring to investors at this kind of point of time, we strongly believe that the spreads on these yields, the spreads on these issuances are understating the risk exposure that investors have to undertake in this Asian high yield space. Next up, coming into the emerging market space. So this is a very interesting space currently, given that we have the mix of EMs in this segment. So our overall sentiment is more inclined towards neutral, largely because of the valuations on the EM bonds. Thus far, credit spreads on EM bonds are below historical average, slightly below, which is similar to what we are seeing on the global high yield bonds. As such, we find greater reasons for investors to look into other areas, given that they are able to find better valuations and also performance in such other markets. So despite saying that, for investors who still want to look into the EM bond space, we have a preference for hard currency over the local currency. The stronger reason is because that we are seeing attractive yields of about 7+% on the EM hard currency bonds, as compared to EM local currency that's only offering about 4+%. So in addition to that, we are also looking at rate cuts being more prominently happening in the EM countries. USD will be supported by the ongoing rate pause we are seeing by the Fed, while local currencies in this EM space will see slight weakening in view of the rate cuts. Lastly, coming to the treasuries. So a simple reason for us to look at treasuries and to buy treasuries now is because risk-free rates have never been so high in a long time. Since the central banks started on the rate hikes, treasury yields of major developed markets have risen to levels not seen since the past decade. The short duration sovereign bonds look particularly attractive, while the longer dated sovereigns, on the other hand, it might offer slightly too little yield to compensate investors for the additional duration risk to be undertaken. So on the US treasuries, the shorter tenors of 1 year or less are offering attractive yields of about 5% or more. On the other hand, for Singapore sovereigns, our T-bills, 6 months and 1 year, it continues to offer about 3.7%. With risk-free rate offering such attractive high yields, it becomes very competitive against the like of corporate bonds and remains a very good consideration within investors' portfolio. On the other hand, for Malaysian government bond, the situation is slightly different given the normal upward sloping curve that we see on a Malaysian government bond yields, in which we will instead prefer the medium-term notes. With that, that is the 6 key themes for our outlook for 2024. For the interest of time, let me quickly pass it on to Jason, who will be bringing you the USD bond market outlook for 2024.
Thank you, Dee-Meng. And this is Jason. I'm Senior Research Analyst from Global Fixed Income. So today's my topic is the USD Fixed Income Outlook 2024. How long will the high interest rate stay? So first of all, regarding USD fixed income, I think most of us will be pay attention to the macro outlook, the interest rate environment, and also the inflation. So let's go ahead. And we believe that the interest rate and the treasury yields will be stay higher for longer. So this mainly because the inflation is hard to tackle by the Fed, and we believe that the inflation rate is unlikely to come down 2% in the short term. So as shown in the chart on the left-hand side, you can see that actually for different countries, how much years to tackle the inflation to return to 2%. Once the inflation rate touch about 5%. So you can see that the average years of time is 18 years. For the shortest time, it also requires 5.7 years. So which means that even though right now the inflation comes down to around 3%, it's kind of the risk for the Fed to have another one of inflation skyrocket. So that's why we will talk about the reasons later. And actually, based on this kind of statistics, we will believe that the inflation issues will be hard for the Fed to tackle it. On the other hand, actually, the market is quite optimistic about the interest rate cut in 2024. And they believe that actually, for the interest rate futures, they are now pricing in 6 rate cuts by the end of 2024. However, based on our base case scenario, we believe that the Fed will not cut the rate in this year. So which is quite not quite follow the consensus. That comes to 2 core reasons. The first one is the inflation, as discussed, and on the other hand, the second reason is the falling recession level expectation. So maybe I go to the next slide, and here you can see that we believe that the structural inflationary factors will still exist. And this kind of inflation is as a result of the past excessively QE and also rising commodity prices, a higher labor wage, and also combined with the supply side pressure brought by the deglobalization. So maybe let me explain it one by one. So for the oil prices, we believe that the energy price and also the oil price will stay higher for longer due to the multi-year structural supply issue in the oil and gas sector. So currently, we can see that the WTI is around $75 per barrel. It's hard for the oil suppliers to have the very good incentive for them to increase the future production. So this boosts the upside pressure on the supply side of the oil and gas. And on the other hand, regarding the food, actually the food CPI, as shown in the chart here, you can see that the food CPI is still quite sticky, and with the high uncertainty on the supply side. For example, the Russia-Ukraine war actually are the major exports of some agricultural commodities, and also the rise of food protectionism and also the extreme weather in different countries like Brazil, Latin America, and also Africa. This also affects kind of price of the agricultural commodities. And the third factors is the employment market. Actually, the current U.S. Employment market is still quite hot. This will result in a surge in the labor rates. So based on previous data in the December of 2023, the unemployment rate was still 3.7%, which is quite close to the level of the full employment. So this will actually is kind of the factor to drive the inflation. And also some other factors like the shelter costs, transportation costs, medical care. These kind of factors will also drive the inflation to goes up in this year. And last but not least, this is a long-term structural factor, which is the deglobalization. Actually, you can see that past few years, the intensive geographical conflicts, for example, the West and China, Russia-Ukraine war, and the recent Israel and Palestinian war, also is kind of the examples of geographical conflicts. And this will result in some kind of relocation of the production lines for different countries. So US may move their production lines from China to another emerging markets or to go back to US. This also will increase the cost of the productions. So overall, these kind of structural long-term issues is hard for the Fed to just use the rising interest rate to tackle the inflation issue in the short term. On the other hand, the second core reasons why we believe that the interest rate and the treasury yields will stay higher for longer, which is the possibility of the hard landing scenario in the US is diminishing. So we see that actually for the corporate earnings, semiconductor sales, and also retail sales, all of them saw a strong rebound after the downturn in 2023. So for the retail sales, actually is quite resilient, as shown in the chart on the left-hand side. You can see that it's an upward trend and also is kind of quite resilient and sticky, which means that consumers is still able to have the strong consumptions, even though there is a higher interest rate environment. On the other hand, regarding the semiconductor sales, we saw a quickly rebound after a small down cycle. So the semiconductor sales already are stronger than the previous peak. So this mainly driven by the AI demand, and a lot of companies, tech companies, or even financial companies also try to invest more capital in this area, also drive the semiconductor sales. And for the corporate earnings, you can see that the US companies' corporate earnings remain solid and strong. So overall, this is kind of signals that showing that US is not a hard landing field. And we think that the recession is unlikely to take place in 2024. Another core factors is that the Biden administrations has significantly increased their fiscal spending. So you can see the chart showing the budget deficit was 6.4 trillion US dollar in the third quarter of 2023, and this will boost the government-related jobs creation, and this also support the overall employment figures. While we saw some layoffs in some big tech and also financial institutions in the past 1 to 2 years, actually the non-farm payrolls looks very strong in the recent months. The number is still grew by more than 200K on the monthly basis. So which is higher than the 10-year average before the COVID period. And this employment condition is quite resilient and also consistent with the soft landing scenario. So these two core factors, the inflation and also the soft landing scenario, actually may have the pressure regarding the long-term yields. So overall, we believe that the long-term bond yields can be still rise. So right now, the 10-year Treasury yields is around 4%. But if you look back into previous period, actually the yield is quite volatile, especially for the long-term yield. So actually, for the long-term yield, you can see that in the last year, October, it's touched over 5%. But after the FOMC meeting in December, actually it's already dropped back to below 4%. So now it's still some upward trend in this 10-year Treasury yield. So right now it's 4%. So based on our view regarding the higher inflation expectation and also with some neutral rates, also term premium, we believe that the overall 10-year Treasury will be able to go up at higher than 5%. So this is our base case scenario. For some extreme case scenario, it even can touch 6%. So due to the upward pressure on the long-term yield, it's not the time to buy the long-term bonds now. So what product can we buy? We can see the next slide. Actually, our team is also our team remain positive on the ultra short-term US Treasuries. So this is mainly for two reasons. The first reason is that this short-term Treasury is still offer a higher yield and also with a stable return. So this actually help the investors to gain some return on top of the idle cash. On the other hand, the second reason is that compared to the long-term bonds, these ultra short-term bonds actually are less sensitive on the interest rate movement and also the bond price movement. So this is a good orders for the investors to look for some safe choice in the fixed income space. Regarding the different subsector, we believe that the high investment grade bonds are more attractive. So even though the current spread of US, European, and also Asian investment grade bonds is only 115 bps, which is quite tight compared to the historical level. However, we believe that the yield at the absolute yield is quite good as they reach at the highest point since 2008. So the high investment grade bond, that is the A grade or above, could be a decent choice for the investors who look for extra yield pickup. And for high yield space, actually, we think is less attractive compared to the IG space. So first of all, as Stephen mentioned, actually the Asian high yield, we think that overall the Chinese real estate crisis is still ongoing, and overall uncertainty is still quite high. And even though they have China government already announced another new policy to support the financing of the real estate developers, it still only lead to a short-term recovery. However, we think that this recovery will not be sustained, and actually for the policy itself, it would not restore the buyers and also the market confidence. So we are bearish on the Asian high yield space. On the other hand, for the US and European high yield, you can see that the bond spread is still quite tight. And we also worrying about the increasing cost of borrowing of the bond issuance for the US and the Europe high yield issuers. It's already rise up to around 8% in the recent months. So these companies, the high yield company, would further need to improve their profitability to cover the interest expense. So that said, even though we expect a soft landing scenario, a higher credit risk and the default cases are likely to come. So I will that's comes up with my part, and now I pass to Thanh Phong to talk about the Ringgit fixed income outlook.
Hi, thank you, Jason. So, first of all, thank you for tuning in, everyone. So, my name is Ting Fong, and today I'll be sharing on what's our view for MYR fixed income outlook for 2024, and also examine why it is a place that you should not ignore. So, before we go into into our MRR outlook for 2024, I think a good place to start with is to understand some of the characteristics of MYR bond space itself. So the first characteristics of MYR fixed income market itself is that it is a place that is pretty much dominated by local players. So if you look at the table itself, in first half of 2023, close to 75% of the participants in the bond space is resident. We can see like players like banking institutions, as well as the well-known EPF, Bank Negara Malaysia playing their parts, while the smaller players here are the non-resident players. So they are only constituting around 25% of the whole percentile. So what this means basically is that the Malaysia bond space doesn't need to rely on foreign capital to eat up the offerings itself. So this also pretty much breeds a very stable ground for the bond players in Malaysia. And the second characteristics of the MRR the fixed income market is that it's a little bit contradict to the first point. In the first point, we say that the foreign players constitute to a small percentile in Malaysia. But then, if you look at the whole environment, if you step back, it's actually that in Malaysia, we have one of the highest foreign investors participation rates in Asia. So if you look at the table itself, in the chart itself, Malaysia actually is one of the top countries in terms of foreign investors participation. So in Malaysia, we actually surpass countries like China, Indonesia, and Korea in terms of foreign participation rates. This is partly due to the fact that Malaysia has one of the largest sukuk markets with 35% of global outstanding sukuk, which is bigger than countries like Saudi Arabia as well as Indonesia. So if you look at the third characteristics of MYR fixed income market, this is a pretty compelling characteristics for Malaysia market. So we can see that we have seen a fairly low default rates since 2012. And if you zoom into the recent few years, you can see that we only seen like 1 to 2 default rates in recent years, and some of the years we even see 0 default rates in the specific year itself. So the latest default rates that we have seen is in 2022 itself, and we've seen 2 default rates in that year. So just for additional information, the 2 default rates that we've seen in 2022 are issuers like Serba Dynamic and Max2. So this makes a very compelling space for bond players in Malaysia. And with that, we basically sums up the characteristics of the Malaysian fixed income market. And next up, we'll be looking at what happens, like what transpired in 2023 itself. So in 2023, we actually see a very modest return from the Malaysia Bond Index. So Malaysia Bond Index has actually delivered a modest 5.9% in 2023 itself, which is standing toe-to-toe with other countries' bond index like the US at 5.5%, as well as the global bond index at 5.7%. So this is Malaysia has been Malaysia bond space has been delivering very stable returns throughout the years. And one fact that I didn't include in this slide is that in 2022 itself, Malaysia has actually still able to deliver a 1% return in terms of its bond index, while the other countries has actually delivered a double-digit negative returns. So for Malaysian investors, stability is what makes it very compelling. And in 2023 itself, we also see that issuance volume has remained more or less stable despite of the rate hike to 3%. We didn't see corporations or even governments hitting the brakes on bond issuance despite of the higher financing costs. Now let us get to the most important part of this sharing session, which is what our projections are for 2024. So what we are expecting in 2024 is that we are expecting a higher inflation number in 2024. This is due to the combination of the subsidy rationalization program that is expected to be realized in phases in 2024, as well as the result of the higher service tax, which is from 6% to 8%. While this is an indirect effect to the inflation number, we think that this spillover is significant enough to actually alter the CPI figure. So taking into consideration of all that, the Ministry of Finance is actually expecting the inflation to be between 2.1% and 3.6% in 2024. And based on our own judgment, we think that the inflation will be around the upper bound of this Ministry of Finance estimation, but not to the point of necessitating a change in the OPR, as the intention of the subsidy rationalization program is to reduce subsidies on the rich, while not having more burden on the poorer segment. And the next projections for 2024 is that we expect OPR to stay put at 3% throughout 2024. This is because we think that an increase in OPR is probably not in the picture, but then a slash in the OPR rate is also less likely in 2024, so as to support the MRR stability against hard currencies like the US, UK, and Japanese yen and all that. And another point is that the wide interest rate differential between Malaysia as well as the US does imply that the Bank Negara Malaysia is more inclined to keep the rate steady, unchanged. So in spite of other countries' future rate decision. So this goes back to the first point that this is to support the MRR stability again. And we do think that this in BNM play card to not cut rates in the early stages of rate cut by other countries as well. So in terms of recommendation for MRR bond investors itself, we think that extending duration is sensible due to the upward sloping curve that we are seeing in Malaysian market. And we think the ideal time frame for extending duration is around 5 to 7 years, just to take advantage of the upward sloping curve while not taking too much duration risk as well. So 5 to 7 years would be the more recommended and the ideal time frame for MRR investors. If you look at the chart on this, we can actually see that MGS 5 years as well as the corporate 5-year AAA, which is the highest credit rating for corporations, the yield spread between these two are around 40 basis points. So we think that there's not much point in going for MGS if the AAA is giving a 40 basis point, is giving out 40 basis point more. So we actually prefer corporate bond over MGS. And we also recommend investors to go for a lower investment grade rating, like A1 and A2 grading, just to take on more of the yield spreads. So let's say that if you take on corporate 5-year AAA, that will give you around an average of 4%. But then if you go into A1, A2 grading, that will give you around 4.8% to 5.5%. So as long as you go into A1, A2 grades with taking into consideration that it is quality names, we think that shouldn't be a problem for Malaysian investors in general. So in summary, just a quick summary, we expect a higher inflation number in 2024, but not to the point of necessitating a change in OPR. And we also expect OPR to stay put at 3%. And thirdly, extending duration is sensible to MYR investors due to the upward sloping curve. And fourthly, we do prefer corporate bond over MGS. We will recommend investors to go into a lower investment grade to take advantage of the yield spreads itself. And with that, I've actually come to the end of my sharing session, and I'll pass it on to Timing to share on the SGD bond outlook.
Hello, thank you so much, Ting Fong. Once again, hello, I'm Timing. I'll be covering the SGD bond market outlook, expecting stability. So after a pretty rough year that we had in 2023, we have reasons to actually believe that yields are likely going to be more stable in 2024. And hopefully this will allow us to actually see more issuances in the SGD corporate debt space. Coming to the next slide. So actually, why did I use the term rough on the SGD bond markets for 2023, even though we did see quite a good positive return for SGD bonds? So just looking at the yields on the Singapore government securities, I'll call them SGS for short, the volatile movements across the year alone should justify why is it a rough year for SGD bonds. So we do see a lot of mark-to-market movements, just like the USD bond markets have been relatively drastic, and the gains were owing just because that we see a significant drop in yields in the final stretch of 2023. So with interest rates being so high and also yields being so volatile, right, it's only natural that most of the corporates actually face quite a lot of difficulty in issuing debt for 2023. So 2023 saw the lowest debt issuances across the past few years since the start of the pandemic in 2020, falling to less than 20 billion worth of SGD issuances. So quite unsurprisingly, issuances generally fell across the board for all sectors except for one, the financial sector. So with banks seeking more funding after a very good profitable year in 2022, as you can see from the news on DBS, OCBC, and also UOB, the SGD bond markets have been a very popular place, not just for Singapore banks, but also for foreign major banks to issue new debt. Financial sector in 2023 accounted for a large majority of issuances in 2023, jumping from a good 46% of total issuances in 2022 to 73% in 2023 itself. So coming to 2024, let us get started on our view for the SGS first. So most of us should already be quite familiar, but in the latest FOMC meeting in December, we did see the Federal Reserve leaving rates unchanged for the third time, which is more or less confirming a rate pause given on the current based on the current data. So with that being said, they also continue to emphasize the fact that they will make decisions based on the ongoing economic data. Meaning to say, they will see how the inflation will go, how the GDP will go, how labor data will go. We dug a little bit into history, looking at the past two rate cycles, 06 to 07 and also 18 to 19. Upon the rate pause period, right, the yields on the longer tenor SGSs, it tends to exhibit a clear trend of either stagnating or to begin gradually falling off. So with this, we believe it will be relatively reasonable for us to actually expect that this same thing will happen for the rate pause that we are currently in. So we expect yields on the SGS to may gradually fall off if the Federal Reserve do continue on this current trend of rate pause, which ultimately this should provide for some form of relief, as we are likely going to see significantly less volatility across the yields as well. So at the shorter end of the curve, We expect yields for the 6 months and 1 year T-bills to remain within the range of 3.7% to 3.9%. This will be similar to the movement in yields on T-bills across 2023 itself, which have mostly remained within this range, even though we did see further rate hikes at the start of the year in 2023. At the same time, with US short-term treasury yields staying higher for longer, this should allow for Singapore short-term treasury yields like your 6 months and 1 year T-bills to actually hold within this range at least for the first half of 2024. So across the various tenors for SGS, we definitely prefer the shorter tenors, that means your 6 months and 1 year T-bills. So we feel that the yields on the longer duration sovereigns, it remains quite insufficient in compensating investors for the duration risk. So following through our expectation of possibly no rate cuts in 2024 in a higher for longer situation, given potential down risk to outside risk to inflation, whereby risk can stay higher for longer as well. We are also seeing very little catalyst for long-term yields to fall, which limits the capital upside. As such, the shorter tenor T-bills continue to look highly attractive over the longer tenor counterparts. So after addressing the sovereign bonds, now it's finally time to talk about the SGD corporate bonds. So we are looking at roughly SGD 13 billion worth of debt issuances to mature in 2024, which is quite a sizable amount that will require refinancing. So should yields do become more stable in 2024, what we believe is it will become more favorable for corporates to consider issuing debt. Two main reasons. Firstly, most corporates have actually opted in the past few years to refinance with shorter term floating bank loans instead of fixed medium-term notes. As such, we believe that corporates will actually face an improvement in the debt maturity schedule and also their credit profile should they opt for medium-term notes instead of these bank loans, especially amidst this greater yield stability that we're expecting in 2024. Secondly, is that we have been seeing very strong demand for new issuances since the end of 2023. This has actually allowed new issuances to price in below expectation. So the potential to actually price in your new issuances cheaper than the expected cost of capital should provide for some motivation for corporates to actually seek the financing in that market. Overall, we expect and we also hope to actually see much more issuances in the SGD market in 2024. And this should give investors such as yourself much more options than what we actually have in the market now. An area that we wish to highlight is the perpetuals or the perpetual securities, particularly given that continued higher than usual non-core risk in 2024. So with interest rates remaining higher for longer, issuers are facing greater stress on credit profile since the start of rate hikes. As a result, the spreads on most SGD perpetuals are at a similar or a higher level than they are on the respective reset rates. For these issuers, reissuing perpetuals for refinancing will not be economically viable, given the costlier coupon at the same benchmark rate that they have. As such, what we believe is that the current environment makes it hard for issuers to be incentivized to call back on their perpetuals, and investors should actually account for this non-core risk into their investment time horizon should investors want to consider perpetuals for the higher coupon. So a couple of perpetuals that we want to highlight in this with a mismatched reset date, meaning to say the reset date is actually on a later date as compared to the first call date. We have Syntech 5.0%, Maple3 MEPL SP 3.7%. This one is slightly special because there is no reset rate at all. This is a fixed for life perpetual. And lastly, we have Keppel Corp KEP SP 2.9%. These three actually have the highest non-call risk, given the fact that issuers will rather sustain the lower interest rate than to choose to issue at a costlier rate. So as a matter of fact, the Singapore Technologies, the Syntech 5%, actually announced that it would not call back the 5.0% perpetual a month ago for reasons similar as to what we have already stated. So meanwhile, for the perpetuals with a step-up margin on reset on the other end, actually includes both Syntech and the Keppel perpetual. These two also have a step-up margin on its reset, just that the reset date is not on the first call date and is instead a few years later. So for the Frasers Property FPLSP 4.98% and Keppel CapitaLand, CPL SP 3.65%. These two have a reset date on the call date itself. And should it be uncalled, there will be a 100% basis point step up additionally to the benchmark rate and initial spread. So for these two, we find these two perks being most incentivized to be called back in 2024, with a non-call risk being most minimized, but not non-existent. Just a reminder, it is not non-existent, given the additional cost associated with the reset on these two issuances. Another last area that we want to highlight, the part being the segment that we like the most are the bank bonds. So the senior and tier 2 papers from banks have been particularly popular in 2023, given the investment grade rating on most of these issuances and also the strong profitability we are seeing from the banks. Looking ahead, we are expecting banks to continue benefiting from the profit tailwinds on the backdrop of interest rates to remain higher for longer and also recovery in loan growth with the stabilized interest rates. Although banks are expecting net interest margin to peak and gradually normalize, earnings are likely to remain higher in the current rates backdrop. Additionally, credit profile of the banks are expected to mostly remain stable in 2024, largely due to a strong profits that is recorded and that has been recorded in 2022 and also 2023, which ultimately this has allowed for improved capital ratios and also buffers. So senior papers are actually the most recommended for us, mainly because of the quality it offers, which also gives the highest seniority across the bank bonds itself. On the other hand, the tier 2 subordinated papers can offer relatively good yield pickup for the additional risk, and that we expect most tier 2 papers to be called back on the first call date. Tier 2 papers will be more suitable for investors who are able to take on slightly higher risk, slightly higher loss absorption risk, although still one tier below the additional tier 1 bonds. Briefly summarizing the SGD bonds outlook for 2024, we have reasons that we'll be seeing stability in 2024 itself. With yields being likely to remain stable in 2024, issuers will be more incentivized to seek the issuance of SGD debt this year. While at the same time, we continue to advocate for T-bills being one of the best picks of short duration. Certain areas of corporate bonds might become more exciting in 2024 with newer issuances, but we do think that bank bonds will likely remain our key preference for 2024. I've come to the end of my part, and thank you so much for following through with our various outlooks.